People sort of get the front month aspect of physical delivery and maybe even conceptually what happened yesterday. But now this morning with headlines about the USOs and the OILs, how do you explain to our viewers what's happening in contracts right now regarding crude?
Sure. So really, the CFTC obviously is watching these markets closely and in real time. And our main job as a regulator is to make sure that whatever's going on in the markets is actually reflective of real supply and demand and not anything else. And I think when we look at this situation, it does appear to be a fundamental supply and demand issue. On the supply side, we've got oil production that continues to increase. It's very hard to cap an oil well to reduce supply. And we also have a storage capacity issue. We've run out of storage space effectively. At the same time, on the demand side, people are asking the question, when will the economy restart? And so all of that is coming together and led to, at least yesterday, the temporary dip in the WTI contract. And in fact, it was somewhat expected because, as many of the viewers know, a futures contract ultimately relies on convergence. At the end of the day, at the end of trading, the futures price needs to be the same as the cash price. So for weeks now, we've seen spot physical cash prices of crude approach zero and even go negative. And so market participants, as well as the CFTC, have actually been preparing for some time to make sure that our trading systems could handle negative prices. But ultimately, it's a fundamental supply and demand issue more generally, but also specifically with the WTI contract.
When the issue is that fundamental, to what degree then does it leave room for other scenarios that involve either forced liquidations or large players being largely out of position, things that point to more counterparty risk?
Yeah, it's a great question. I mean, the good news here is that very few people stay in the contract when it goes into the delivery period. So the amount of people that are actually in these markets is reduced significantly to a very small number, in some cases mainly those that are already hedging. So they've already reduced their exposure by this contract when you get to the delivery period. And, of course, the May contract expires today. It closes at 2 p.m. Central. And so very few people were actually in the contract compared to who are normally in the contract. So that reduces counterparty risk. And I'm pleased to say that all of our clearinghouses, which collect variation and initial margin payments, all variation and initial margin payments were made yesterday throughout the day. So no one missed margin payments.
Yeah, Heath, I'm glad you brought up the margin payments because historically when we see price go up dramatically, we see volatility moving in the other direction. Those margin requirements tend to be raised to slow the price action. So in light of the lack of liquidity and the lack of buyers that we're seeing in crude right now, are you engaged in discussions to consider actually lowering the initial margin requirements?
No, I think not at this time. The initial margins obviously were increased due to the last big spike that we saw in mid-March. And so as a result, those initial margins have actually served as a cushion against defaults. The thing to think about here is that we don't think initial margins will rise dramatically because, again, this was just a single contract on a single month. We didn't see the level of volatility in the June contract and the July contract, just this closing period for this one contract. So we're not expecting initial margin levels to dramatically increase as a result of what happened yesterday.
So you don't think we're going to see continued volatility, extreme volatility into the June contract, for example? And I ask that in part because we saw the USO, the ETF that offers investors, retail investors, potential exposure to WTI crude oil futures temporarily halted earlier today. They were looking to take on more shares. It looks like the SEC is not moving forward with that. And now you have some investors out there that are warning that you could actually see a break from fundamentals there. And given the fact that it is tied to the futures contract and the USO is essentially the biggest buyer of those contracts in the market, how concerning is that?
Yeah, I think we're going to continue to see volatility as those key inputs that I mentioned earlier on the supply side, both the actual availability of supply and then the storage cost, as well as the question as to when the economy will open. All of those will continue to drive the futures price as well as the spot market price. And I think as a result, if there continues to be uncertainty on any one of those three factors and all of them combined, we'll continue to see volatility. It's just that yesterday, because the negativity only occurred within the May front month contract, the volatility was actually not as extreme as the volatility that we saw last month because it went across the curve and into the curve. So today, if you look, for example, the July Brent contract and the July WTI contract are pretty tight in terms of spread. So they're not as wide as we saw yesterday. And so, but again, time will tell, and it's going to be those three fundamental factors that will dictate it.